Hello and welcome to episode number 25 of the Zach's Tech Talk Tuesday podcast. My name is Ryan McQueeney, and this week we actually have a very special episode. I'm going to be joined by a special guest. His name is Ben Phillips. He is the CIO of EventShares. Ben is, as I said, the Chief Investment Officer of EventShares. He oversees the research and portfolio management for the advisor and chairs the investment committee for each of the company's funds. He is a CFA charter holder and previously has worked for Goldman Sachs Asset Management, Providence Equity Partners, and Lord Abbett. So EventShares, if you're not familiar, is the firm behind a family of actively managed exchange-traded funds that seek to offer exposure to geopolitical and policy-driven events in the U.S. and around the world. So in other words, ETFs that are seeking to kind of make an investment strategy around a particular political policy. In this case, we're talking about EventShares U.S Tax Reform Fund, which trades under the ticker TAXR, that's TAXR. This is an actively managed ETF designed to invest in companies that will be positively impacted by the enactment of the recent changes to the U.S. tax code. Now, what does this have to do with our kind of tech focus? Well, as I'm sure many of you know, and as I'm sure we have kind of brought up on the show a few times now, many investors in the technology sector are really excited about the recent tax reform bill because of several noteworthy companies kind of already promising to bring overseas cash back home as a part of kind of a one-time repatriation charge in the new tax bill. However, Ben and the EventShares team view this one-time event as something that will not be a long-term growth catalyst in the same way that tax reform will drive other sectors. So TAXR is actually underweight tech stocks in comparison to the Russell 3000. And so Ben and I discuss this kind of strategy and dig even further into the strategy that goes behind TAXR. The two of us also discuss the tech stocks that do appear in the fund and kind of highlight some of the reasons why those particular tech companies should be able to benefit from tax reform more so than others. So yeah, it was great to have Ben on. It was a great conversation, and check it out. Ben, we've heard a lot about how the GOP's tax reform bill is a winner for Wall Street. The bill will inevitably affect different sectors and industries in different ways, but one of the biggest stories to emerge from this whole process centers on how these massive tech companies will benefit from a one-time repatriation clause related to their overseas cash. Nevertheless, it looks like EventShares is avoiding some of these large-cap tech stocks right now. Can you explain this strategy for us?
Yes, Ryan. I mean, I think you hit on it right there. You said it's a one-time clause, and I think that's really what we're viewing it as. It's really a one-time boost to the cash balance, and I think the real question is, what are these companies going to do with it? Our view currently is these companies are likely going to sit on it. I don't think they're going to go out and do large M&A, just given where valuations are in the tech space. I think they're potentially going to do a one-time dividend or increase their dividend or some share buybacks. But again, these are all kind of one-time benefits. What we're looking at is really companies who are going to benefit from the tax cut, from CapEx deductibility, and from improved export position from the U.S. And so that's really how we built our portfolio. And when we took the Russell 3000 as our starting point, we screened it down to 300 names based on our quantitative screen, and then really dove in name by name. And we weren't thinking about specific industries. We were really looking at the companies, the top 40, who were going to be beneficiaries from tax reform, and that's what ended up in the portfolio. And I would just say the underweight to tech really is a result of that bottoms-up portfolio construction. I think it's also important to point out that the companies we're looking at are going to get a permanent boost to EPS, and this is going to last for decades to come. And we think putting a multiple on that, say 20 times earnings multiple on average, makes sense versus just this one-time tax benefit.
Cool. Yeah, I want to hit on a little bit more of what you, I think, started to mention there. It looks like the fund, as you said, is underweight on tech, with its current holdings, including about, correct me if I'm wrong, but about 13% tech
That's right.
stocks compared to the Russell 3000, which is at about 23%. So, besides the concerns over the repatriation clause not being necessarily a long term growth driver, are there any other reasons that you think has caused the fund to be underweight on tech?
Well, I think part of that bottoms up analysis when we were looking at those 300 names that we had identified as potential tax reform winners, we went through and did traditional fundamental analysis, and that includes a view on valuation. So looking at multiple valuation data points. And I think we came away from a variety of the tech names and a large portion of them and said, the valuations are kind of at peak multiples. Yes, I get there's some secular changes and tailwinds going on for tech companies, but tech is cyclical at the end of the day, and we think we're kind of approaching near the top of the cycle, and that definitely came into consideration. I think also the mega cap tech names that a lot of your listeners are familiar with, you think the FANGs, they tend to be overfollowed, and they're overfollowed by the street. They're overfollowed by sell-side analysts and really individual investors and also the media. Highly scrutinize these companies, and it's tough to really gain an edge from a portfolio manager's seat like mine and truly identify something that's changing for the better and has a real fundamental story that's embedded within it. And so, I think that's how we got to the names in our portfolio was really the bottoms up. And I think we have a good selection of names in that 13%. We think they're really strong tech names. They're just ones that maybe not everyone has heard of.
It's a really interesting perspective to have on things, of course. And however, the fund weighting at 13% tech, of course, means there is some tech in it. So there's bound to be a few tech names that my listeners are perhaps familiar with or should be familiar with. What types of tech companies has the fund included, and why do these stick out?
Sure. Because it's a concentrated portfolio, I could just give you a quick rundown of each one of them. There's only 5 distinct tech names in the TAXR portfolio. One is Benchmark Electronics. This is a diversified electronics manufacturer, printed circuit boards, assembly, a variety of industries, 70% of their revenue within the U.S. Strong company. They have a decently high tax rate. It's actually one of the lower ones in the tech portfolio, but they really benefit from the U.S. manufacturing. So they manufacture a lot of their products here. And with tax reform, they stand to be a larger exporter out of the U.S. And so we think that's going to cause a long-term earnings tailwind to Benchmark. We have EchoStar, that's a satellite company. They provide broadband services, huge CapEx, almost 30% of revenue. They pay a mid-20s tax rate, so they'll get some benefit from the tax cut, but really that's a CapEx play. And then we have Fiserv. This is information technology, financial IT, payment processing, high tax rate there, 33% typically, and decently high CapEx actually. And then we have Qualys, QLYS. They're a cybersecurity leader. They're a high U.S. taxpayer. And so that one, I think, fits the bill as well. And the last one is Teradata, TDC. 20% of their market cap is held in cash overseas, and they're a big beneficiary of this move to the territorial system, so earnings repatriation kind of on a long-term basis. 60% of the revenues in the U.S., and they do pay around a 30% tax rate, so they're going to benefit from the tax cut as well.
Well, thanks for running us through that list. It's great to hear the specific names within the fund, but we also appreciate hearing, those kind of line-by-line reasons why they were included. I just want to wrap things up here by giving you the opportunity to talk more about the Tax Reform Fund in a more general sense. So it's going to be kind of a few questions and answer them however you'd like. But what else should my listeners know about the fund? Where can they go to learn more about it? And most importantly, how long after these reforms are implemented will this fund remain relevant?
Sure. Well, I'll start with the easy one first. So your listeners can go to EventShares.com and learn a lot more about all of our funds, including the GOP and DEMS fund. We're really a policy-first investing firm, so the first ever firm that is using policy as a driver for portfolio construction. And so it's taking policy initiatives and then looking at fundamental portfolio construction approach and building good portfolios. So we're trying to pick good portfolios with embedded policy catalysts. There's fund fact sheets I would guide you to on each one of the fund pages. They tell you every single of the stocks in the portfolios, and they're updated daily. So any changes we're making, you will see. We're fully transparent and very, full open kimono with what we're doing in our portfolios. I think it's really also important to know that tax reform really it's just passed, and it hasn't started flowing through to these companies' bottom lines, and it's going to start doing so in Q1 earnings, Q2 earnings of this year. So we're really going to see the benefit in these companies' earnings, and I think that's when the street and other investors are going to wake up and say, wait a second, these companies really are seeing a earnings boost from tax reform, and I think that's when you'll see the next step up in revaluation in these companies, and I would expect that's when our fund really shows some strong performance. I mean, my expectation is as the year progresses, people will start understanding that this tax reform has provided a material tailwind to our 40 high conviction best idea names that populate the TAXR portfolio. And so I would say stay tuned for 2018. I think it's going to be a great year for the fund, and I think EventShares is really doing something different in the way we approach investing. And follow us on all the social media as well. We're very active on social media. LinkedIn, Facebook, Twitter. We're also on StockTwits and Seeking Alpha. So definitely stay tuned and follow us if you want. It's at EventShares ETFs is our handle.
Awesome. Definitely encourage my listeners to check that out. Again, that is eventshares.com for more information. Thank you so much for joining us, Ben. It was interesting to hear your perspective on this new tax reform and to hear more about your fund strategy.
Thanks for having me, Ryan. It was a real pleasure.